The banks are not blocking crypto regulation because they hate crypto. They are blocking it because they understand exactly what it means for their business model. And that single fact explains almost everything happening in Washington right now around digital asset legislation. The most important financial policy fight of this decade is not happening between crypto believers and crypto skeptics. It is happening between the institutions that currently control how money is stored, moved, and settled, and a new set of players who are building infrastructure that could make parts of that existing system unnecessary. The fight looks like a political debate about stablecoins and regulatory frameworks. But underneath the surface, it is a direct conflict over hundreds of billions of dollars in deposit revenue, and the banks know it. If you want to understand why crypto legislation keeps stalling, why certain regulatory decisions keep getting made, and what all of it means for the structure of the financial system over the next decade, you need to understand the incentives driving every player in this fight. That is what this video is about. Let's start with the Clarity Act, because it is the clearest example of where this conflict is playing out right now. The Clarity Act is legislation designed to provide a definitive legal framework for digital assets in the United States. It would clarify which assets are securities regulated by the SEC, which are digital commodities regulated by the CFTC, and what rules apply to the businesses operating in this space. The bill passed the House with genuine bipartisan support in 2025. That is significant because bipartisan support for anything in the current political environment is unusual. It reflected a recognition across party lines that the absence of a clear legal framework for digital assets was hurting American competitiveness, driving innovation offshore, and leaving consumers without adequate protections. By every normal measure of the legislative process, a bill with bipartisan House support addressing a clearly defined market problem should have moved through the Senate with reasonable speed. It did not. And the reason it did not is important because it reveals exactly who is driving the resistance and why. The opposition to the Clarity Act in its current form is not coming from lawmakers who believe digital assets are dangerous. It is not coming from consumer advocates worried about investor protection. It is coming from the banking industry. And the banking industry's objection is focused on one specific provision: the question of whether stablecoin issuers should be allowed to pay rewards to holders of their stablecoins. To understand why stablecoin rewards are the sticking point that is holding up an entire piece of legislation, you need to understand what stablecoins actually threaten for the banking industry. A stablecoin is a digital asset pegged to the value of a traditional currency, typically the US dollar. When you hold a dollar-denominated stablecoin, you are holding something that functions like a dollar, but that exists on a blockchain network rather than in a bank account. Now here is the question that is breaking the political compromise. Should stablecoin issuers be allowed to pay their holders a yield, a return on those holdings, similar to the interest a bank pays on a savings account? Crypto companies say yes, obviously. If a stablecoin issuer is holding the underlying dollar reserves and earning a return on those reserves, being able to share some of that return with holders makes the product more useful, more competitive, and more attractive to consumers. The banks say absolutely not. Their argument is that a stablecoin paying yield is functionally equivalent to a bank deposit. And if it is functionally equivalent to a bank deposit, it should be subject to the same regulatory requirements, including capital requirements, deposit insurance, and prudential oversight. The White House attempted to negotiate a middle ground, proposing that stablecoin rewards could be permitted in limited peer-to-peer transaction contexts while being restricted in contexts that more closely resemble traditional banking deposits. The banks rejected that compromise, and their rejection is not really about regulatory fairness or consumer safety. It is about the fact that if stablecoins can offer competitive yields without the regulatory cost burden that banks carry, they become a genuinely attractive alternative to keeping money in a traditional bank account. That is a direct threat to the deposit base that is one of the most valuable assets a bank holds. The Clarity Act is stalled not because of a policy disagreement about digital assets. It is stalled because one of the most powerful lobbying forces in American politics does not want a piece of legislation to pass that would accelerate a competitive threat to their core business. While the legislative fight continues in Washington, a regulatory decision came through in early 2026 that is quietly reshaping how the financial industry thinks about blockchain technology. The Office of the Comptroller of the Currency, the Federal Reserve, and the FDIC jointly issued guidance stating that tokenized securities, meaning traditional financial assets like stocks and bonds that have been represented as digital tokens on a blockchain, should receive the same capital treatment as their traditional equivalents. In plain language, this means that if a bank holds a tokenized version of a U.S. Treasury bond, it does not face additional capital penalties compared to holding a traditional Treasury bond. That might sound like a technical accounting detail. It is actually one of the most consequential regulatory decisions for the adoption of blockchain in mainstream finance that has been made in years. Here's why. For large financial institutions, capital treatment determines the economics of holding any asset. If a tokenized asset carries a higher capital charge than its traditional equivalent, the institution has a direct financial incentive not to use the tokenized version, regardless of whether it is technically superior. By equalizing the capital treatment, regulators have removed one of the most significant structural barriers to institutional adoption of tokenized financial instruments. Banks can now explore using public or private blockchain infrastructure for security settlement, custody, and transfer without the economics working against them. And this is directly relevant to companies like Ripple, which have been building custody and settlement infrastructure for tokenized assets, and which now operate through a nationally chartered bank, positioning them to offer regulated digital asset custody services to institutional clients within the existing U.S. banking framework. This is where Ripple's recent moves become particularly significant, because they are happening at the exact moment when the regulatory environment is becoming more favorable for exactly the kind of infrastructure Ripple has been building. Ripple rebranded its institutional services division as Ripple Prime in early March 2026. And almost simultaneously, Ripple Prime was listed in the National Securities Clearing Corporation Participant Directory, which is operated by DTCC. Let's be clear about what that means. DTCC, the Depository Trust and Clearing Corporation, is the post-trade infrastructure backbone of the U.S. financial system. It clears and settles the majority of U.S. securities transactions, handling trillions of dollars every single day. When Ripple Prime gets listed as a recognized participant in the NSCC directory, it means that Ripple's infrastructure is being formally recognized as part of the post-trade settlement ecosystem that Wall Street's largest institutions use every day. That is not a marketing claim. That is an operational designation within one of the most critical pieces of financial infrastructure in the world. At the same time, clients of Ripple Prime gained access to a full suite of crypto derivatives through Coinbase, operating within a CFTC-regulated environment. Ripple has also articulated a clear strategic objective of building significant daily trading and settlement volume through the XRP ecosystem, with the stated goal of eventually supporting volumes in the range of tens of billions of dollars per day, with the potential to scale further as additional institutional partners join the network. The XRP ledger is being positioned not as a speculative asset platform, but as a settlement layer for institutional financial activity, and the infrastructure moves being made right now are the foundation for that positioning. The Ripple story is important, but it is not happening in isolation. The institutional moves being made across the broader digital asset space in this same period collectively signal a fundamental shift in how the largest players in traditional finance are positioning themselves. Morgan Stanley, one of the most prestigious investment banks in the world, submitted an application to launch Bitcoin exchange-traded funds. Morgan Stanley is not a company that makes speculative bets on emerging technology. It is an institution that moves carefully with enormous amounts of due diligence and with a primary obligation to its institutional and high-net-worth clients. The fact that Morgan Stanley is seeking to offer Bitcoin ETF products is a signal that the institution believes demand from its client base for regulated exposure to digital assets is real, significant, and growing. In a separate but equally significant development, Kraken Financial, the banking subsidiary of the Kraken crypto exchange, received a Federal Reserve master account. A master account gives a financial institution direct access to the Federal Reserve's payment system, including the ability to hold reserves at the Fed and to transact directly within the U.S. payment infrastructure without needing a correspondent bank as an intermediary. No crypto-native entity had ever received this designation before. Traditional banks immediately objected, arguing that granting master accounts to crypto firms creates systemic risk. But the more honest interpretation of the objection is that it creates competition. A crypto exchange with a Federal Reserve master account can offer services that previously required a traditional banking relationship. And then there is the ICE and OKX partnership. ICE, the Intercontinental Exchange, is the company that owns the New York Stock Exchange. It made a direct investment in OKX, the major crypto exchange, and placed a representative on OKX's board of directors. OKX will use this relationship to provide its more than 120 million users with access to regulated futures contracts and tokenized equity markets in New York. The owner of the New York Stock Exchange is now directly invested in a crypto exchange and is using that relationship to bring crypto users into regulated U.S. financial markets. Pull back and look at what all of these developments have in common, because the pattern is unmistakable. Tokenized securities getting equal capital treatment. A crypto firm integrated into DTCC settlement infrastructure. A crypto exchange receiving a Federal Reserve master account. The owner of the New York Stock Exchange investing in a crypto trading platform. A major investment bank seeking to offer crypto ETF products. These are not the moves of an industry that is being tolerated at the margins of the financial system. These are the moves of an industry that is being actively integrated into the core of the financial system. The tokenization of financial assets, meaning the representation of stocks, bonds, real estate, and other assets as digital tokens on blockchain networks, has the potential to fundamentally change how markets work. Settlement that currently takes 2 days could happen in seconds. Assets that currently require complex custody arrangements could be held and transferred with cryptographic security. Financial instruments that are currently accessible only to institutional investors could be fractionalized and made available to a much broader range of market participants. The regulatory guidance on capital treatment for tokenized securities was a signal that this transition is now being actively supported rather than merely tolerated. The integration of companies like Ripple into DTCC infrastructure is a signal that the plumbing for tokenized settlement is being built inside the existing financial architecture rather than alongside it. We are not at the end of this transition. We are at the beginning of it. But the direction of travel is no longer uncertain. The question is not whether digital assets will become part of mainstream financial infrastructure. The question is how quickly that integration will happen and which companies will be best positioned to provide the infrastructure when it does. Here is the honest conclusion that all of this evidence points to. The financial system is entering a transition phase where the distinction between traditional finance and digital finance is gradually becoming less meaningful. That transition is being driven not by ideology or speculation, but by the straightforward logic of better infrastructure. Atomic settlement is faster and cheaper than T+2 settlement. Blockchain-based custody is more transparent and auditable than traditional custody. Tokenized assets can be fractionalized, transferred, and settled in ways that traditional assets cannot. The institutions that are making moves right now, whether it is Ripple integrating with DTCC, Morgan Stanley entering the Bitcoin ETF space, or Kraken getting a Federal Reserve master account, are positioning themselves to operate in a world where these infrastructure advantages are widely recognized and institutionally adopted. The Clarity Act may still be stalled. The stablecoin rewards fight may continue for months. But the underlying momentum toward a more deeply integrated digital financial system is not dependent on any single piece of legislation. It is being built transaction by transaction, partnership by partnership, and regulatory decision by regulatory decision. The banks fighting to slow down stablecoin regulation are fighting a rearguard action against a transition that is already well underway. Understanding that transition and the incentives driving every player in it is the most useful thing anyone following this space can do right now. This video is for educational purposes only and does not constitute financial advice. Nothing discussed here should be interpreted as a recommendation to buy, sell, or hold any financial asset. Always conduct your own research and consult a qualified financial professional before making any investment decisions.